The quantum sector has graduated into a commercial-grade infrastructure. The inflection points achieved between 2024 and 2026 have stabilized the asset class into a permanent fixture of the global deep tech economy. This chart shows the projected global revenue growth for the quantum computing market. We are looking at a sector that held a $1.2 billion valuation in 2024, but is modeled to aggressively scale toward $27.6 billion by 2035. That expansion represents a compound annual growth rate climbing as high as 36%. This growth is driven primarily by cloud-based quantum as a service, allowing enterprise clients to lease compute time on demand without the capital expenditure of purchasing physical hardware. Look at the public markets. When Quantinuum filed for its IPO in mid-2026, it recorded $30.9 million in trailing annual revenue, yet the offering targeted a fully diluted valuation of up to $14.3 billion, a 460 times revenue multiple. Skeptical. For institutional allocators, this creates an immediate paradox. How do you mathematically underwrite an asset class commanding these multiples when it lacks standard, classical cash flows? Institutional capital isn't operating on speculation. The market is actively pricing in a series of engineering breakthroughs and multi-billion-dollar sovereign equity interventions that guarantee operational runway for the next decade. To accurately model the trajectory of the global technology stack, understanding the physics of quantum error correction has become a mandatory prerequisite. To grasp the magnitude of recent milestones, we have to look at the primary constraint that stalled the industry prior to 2024, the scalability wall. Quantum bits, or qubits, leverage superposition and entanglement to process data, but they suffer from an extreme vulnerability called decoherence. The slightest thermal fluctuation or electromagnetic interference causes the quantum state to instantly collapse, resulting in computational errors. Early architectures faced a recurring failure. Adding more physical qubits to a processor increased the noise and the error rate, preventing the systems from performing useful, error-free calculations. The sector required a shift toward utility-scale, fault-tolerant computing. This meant weaving thousands of noisy physical qubits into stable, logical qubits, a barrier that was breached across multiple hardware modalities between 2024 and 2026. In late 2024, Google Quantum AI unveiled the 105-qubit Willow processor. This superconducting chip achieved below-threshold quantum error correction. By scaling a surface code across distance 3, distance 5, and distance 7 grids, Willow proved that adding more physical qubits to a logical group could actually reduce the total error rate. At each step up in grid size, the logical error rate fell by roughly half. This diagram compares the rigid, two-dimensional superconducting grid on the left with the dynamic neutral atom array on the right. Instead of fixing qubits onto silicon, this system uses focused laser beams to suspend and dynamically rearrange individual atoms during computation, enabling flexible any-to-any connectivity. This physical flexibility unlocks high-rate quantum low-density parity check codes. Unlike traditional surface codes that require thousands of physical qubits to create a single logical qubit, these QLDPC codes achieve an encoding rate of roughly 30%. This efficiency accelerates the commercial timeline. Constructing a machine capable of running Shor's algorithm to break 256-bit encryption drops from a requirement of millions of superconducting qubits to as few as 10,000 to 26,000 neutral atom qubits. This exponential reduction shifts the roadmap for utility-scale deployment. Engineering a cryptographically relevant machine is now a scheduled production target rather than a speculative objective.
Beyond the competition to build the superior processor, a more immediate investment opportunity exists within the agnostic physical infrastructure required to operate these systems. To maintain coherence, qubits must be housed in dilution refrigerators cooled to 10 or 15 millikelvin, temperatures colder than the vacuum of deep space. The market for these specialized refrigerators is dominated by a single Finnish company, Blueforce, which has shipped over 1,800 systems. This creates a severe manufacturer bottleneck for both sovereign and private programs. This hardware relies on a critical material shortage, helium-3. Because this isotope is ultra-rare, manufacturers are signing forward purchase agreements for lunar-sourced extraction. A secondary choke point exists in the microwave control electronics. This layer is geographically concentrated in the Netherlands around companies like Qblocks and remains heavily exposed to global shortages in advanced FPGA chips. The most stable capital exposure resides within these single-digit vendor monopolies. They secure margins by providing the specialized hardware and materials that remain essential regardless of which processing architecture eventually leads the market. Global governments have realized that quantum computing leadership is synonymous with national security, and that realization is driving a direct intervention in the market. This chart details an unprecedented policy shift. In May 2026, the U.S. government deployed $2 billion across 9 quantum companies under the CHIPS Act. Bypassing traditional research grants, the state opted to take non-controlling minority equity stakes, effectively becoming a lead venture capital investor. This sends an immediate signal to private markets. The federal government is aggressively validating the near-term commercial viability of the hardware and intends to participate in the financial upside. State ownership does introduce new governance risks. Investors must account for complex dynamics regarding intellectual property licensing, strict export controls, and the prioritization of defense use cases over commercial expansion. These sovereign equity injections provide a guaranteed capital runway and a firm valuation floor. This state-backed stability allows hardware developers to sustain high R&D costs until their processors achieve fault-tolerant commercial utility. While hardware continues to scale, the threat it poses to current encryption has created a massive, immediate market for defensive software. Adversaries are currently employing harvest now, decrypt later strategies, intercepting encrypted data today with the intention of decrypting it the moment quantum hardware reaches maturity. In response, global regulators have finalized new NIST standards. This forces a global overhaul of IT infrastructure to use lattice-based and stateless hash cryptographic algorithms that are natively resistant to quantum decryption. For enterprises, this requires crypto agility, the capacity to swap out encryption algorithms without rewriting core application logic. This mandated migration represents a decade of forced technology spending. The software vendors facilitating this transition represent the most stable and immediate revenue opportunities in the entire quantum ecosystem. To allocate capital, institutional investors must utilize a 3-pillar framework. First, prioritize near-term cash flow through post-quantum cryptography migration. Second, secure infrastructure moats by investing in monopolies controlling cryogenics, electronics, and foundries. Third, allocate for long-term upside by backing pure-play hardware developers with sovereign equity. The milestones reached between 2024 and 2026 establish quantum computing as an immediate strategic requirement. From the mandatory migration to new encryption standards to the native simulation of industrial catalysts, the technology is integrating into the hardware layers of the global economy.